Hi, this is Brett with Trade Therapy, and welcome back to the Trading Couch. We're talking about Moderna, part of our top-down analysis for United Healthcare last week, and you're not going to find a better textbook example of distribution than Moderna here. And we're going to walk through a couple of monthly charts and talk through how we identified this as distribution back in late 2021 and 2022. And then we're going to talk about the current situation with Moderna and what similarities do we see from July of 2021 to today. Before we do that, need to let everyone know we don't have a position in Moderna. All of our content, including this video, is intended for educational purposes only. Trading involves risk. Trade according to your own risk tolerance. Do your own due diligence and trade according to your own plan. If we take a look at this monthly chart here from July of 2022, we see this massive run during the COVID market. You can see that every time there was a dip, buyers were rewarded with massive, sometimes price extensions away from the short-term moving averages. That's part of the conditioning process of what Wall Street is doing when they reward dip buyers like this, especially as you get up into the later stages of the markup campaign. They're conditioning retail traders to buy the dip so that when they do distribute, when they do exit their long positions, retail investors will step in and buy the dip and basically buying what Wall Street is trying to sell, which is their long position. And you can see some evidence of that when you see these hammer candles forming with these long lower wicks as price decline. There's no follow through on these. Dip buyers were not rewarded. They continued to be punished. But after a big run like this, retail buyers still stepping in. It's a story as old as time. Retail always buys the top, and this is a clear example of how Wall Street does it. These tighter candles show up again as price is trying to press up and trying to follow through here. What that is short covering. As Wall Street closes long positions, they take short positions. They'll then come down and take profit. That will then create a temporary relief rally that is intended to bring retail back into the trade. At the time, back in July of 2022, we were watching this very carefully to see if we would see an extension heading into the later parts of 2022 and possibly early 2023. Were we going to see that short covering? Were we going to see that liquidity trap come in before the real markdown campaign began? Things that we identified for distribution: back-to-back evening stars or shooting candle stars, these back-to-back hammers with no follow-through, massive volume on these smaller body candles. That is a telltale sign of institutional activity. And after a big run like this, obviously they're recognizing gains and taking profits. So that was the situation back in the summer of 2022. And if we jump over to a current monthly chart and go back, we can see that as we got into the last quarter of 2023, we did see that extension. We did see the short covering. We did see retail get lured back into the trade as evidenced by this long wick on top. That is all of the retail dip buyers here thinking that they timed it perfectly, scaling into their long positions, only to find supply come back in. And the real markdown campaign really kicked off at this time. You can see price drop back down all the moving averages and then never really recover and fight the declining moving averages on the way down. We did see a redistribution structure form. Again, profit taking from short positions. The short positions are reloaded, and then the final push down, then the dramatic push down into where price is currently ranging in the high 20s here. So a couple of things that jump out about this. This inverse Fibonacci that we ran with the 0 at the top, the 1 at the bottom, it's inverse. That gives us targets for the markdown process. The 786 level where price is currently at is very common for high beta assets to distribute back down to a 786 retracement. It's also at the top of this market structure, which was the original accumulation structure prior to the big COVID run. We do see all-time demand line here. We do see a higher low forming that is in conflict with the lower low from our momentum indicator, which is relative strength index. we also start to see some similarities developing. We saw back here, which is these small body candles on higher volume. Whenever you see the small body candles on high volume, we're not getting the big dramatic spikes that we got back here because Wall Street doesn't like to attract attention to their long positions. But we do see small body candles. We do see price being held within a range. We do see an extended period of higher volume. These are all indications that Wall Street and institutional money is acquiring a long position. We're watching it very closely to see if price can begin to break above some of these shorter term moving averages that are now flattening. You see these moving averages that have spread out. That means there's not a lot of resistance here. So if we can get some sort of an upthrust to get over these shorter term moving averages, that there is the possibility for rapid price movement. If we look back in that range, we can see there's been rapid price movement in this area. So it's possible we could see some sort of a rapid price advance up out of this range. So these are the things that we're going to be keeping a close eye on. All of the similarities between accumulation and distribution really kind of stand out here. High volume, small body candles. We'll see if we get follow through on that. We'll be tracking it again. No position for us in Moderna, but we're considering a long position from here. That's all the time we've got for Moderna this week. We'll see you back here on the Trading Couch next week.